Okay, this week was really a nothing burger from a market and economic report standpoint. There wasn't a lot of activity. There wasn't really anything being reported on. But I did, and I want to start with this. We have got to be the stupidest country in the world. This thing that the uh, current administration thinks is a good idea, and I'm sure you've heard about it. And but if you haven't, they're going to hike payments for good credit home buyers to subsidize high risk mortgages. So in other words, what they're saying here is if you have credit scores of 680 or higher, uh, you'll pay more, about $40 a month more on a home loan of $400,000 to subsidize basically um, those that are high risk mortgages. And home buyers who make down payments of 15 to 20% will get socked with the largest fees. Now, how does this make any sense? Almost everybody tries to get their, especially when you're young, try to get their credit score high so that they can get a home. That's the whole aim, is to work hard and do those types of things. But no, what we're going to do is reward those that have low credit scores, are high risk, and have others pay for the their the down payments because they have good credit scores and because they make a larger payment. I mean, this is upside down world from my perspective. I don't get this at all. This is insanity. This is, I mean, I've we've seen a lot of things lately that I totally disagree with, but this is upside down. This is going to create even a worse economy, especially as some of these people go out and buy homes and they are unable to make the payments on that home. So there you go. Lower your credit score so you don't get hit with $40 a month, or make less of a down payment. That it just doesn't. I can't. I can't even. Well, anyway, let's look at this past week. Um, and we'll start with manufacturing, which is typically where I start. And it was kind of a surprise that the New York manufacturing index was up 10.8, and all I can think of is maybe this is some type of anomaly, that because you can see it's been negative for such a period of time. I don't have anything really on what happened there. I don't know much about what's behind the numbers, but I wouldn't. I would expect this not to continue. I hope I'm wrong, but that would be my expectation. Tuesday we had building permits. Consensus was 1.45 million. Was actually 1.413, which shows a weakening of the housing market. Housing starts actually came in above consensus but below the previous period. So, that's kind of a wash from my perspective. I had warned last week about the 30-year mortgage rate. On Wednesday, it was reported 6.43%. We'll take a look at the 10-year when we get to the markets and the data there. But my expectation is that it'll be pretty close to this number. I don't think there'll be much movement next week, unless again something could happen with the 10-year. Thursday, initial job claims came out above the consensus, 245,000. So now we're starting to get this kind of miss on the jobless claims, where we're always below at the initial jobless claims, and now we're starting to be above the consensus, and the numbers are getting bigger. And again, nothing goes in a straight line, but my expectation that this thing will continue to grow over time. And let's see what else we have. We also had another manufacturing, Philly manufacturing. Now it came down was down 31.3%, and it was expected to be down 19.2%. So it was a large miss. This in the New York Empire State Manufacturing Index was a big win, I guess. And then Friday, today, we had the PMI come out, and it came out better than expected. And all these things obviously play into the hands of the Fed. Look, the economy is strong, and all of those things. So that was this week. And like I said, there wasn't really anything that really moved the markets, maybe a little bit on each day. And we'll see that in the market data. But then next week, it starts to get a little bit more interesting. Now we get some of the manufacturing. Maybe they can be the Dallas manufacturing index, Fed manufacturing index. Maybe if it comes, down more than expected, the 17 minus 17, be at the tiebreaker. But we have Tuesday next week. We have home prices. It's been in the negatives for over 6 months now. And we also have consumer confidence. And, I'm watching this. We had this in one of the previous weekly updates, was about, deflation and high interest rates, and then consumer confidence starting to erode. But we haven't seen the big erosion yet in consumer confidence. But we'll see how these numbers continue to come out. Expectation is pretty much in line with what it was last month. But if this thing starts to erode, then we may have the starts of a deflationary bust. Then we have building permits reported on Tuesday. Wednesday, we have durable goods orders. And durable goods orders, just like the manufacturing, is usually dependent on home sales, and you're buying things for your new home, and so if homes aren't being sold, it's a big driver, obviously, of the economy, is real estate, and maybe that's why we're subsidizing people who have poor credit scores. I don't know. The mortgage rate, I talked about that. I will look at the 10-year here in a minute. GDP growth rate, 2% is consensus. It's nothing to write home about. Friday is kind of the big thing, and the only thing that really matters. Personal income has some effect, but PC, it's all going to be about the PC on Friday, and everything will basically feed into both what the Fed's going to do if something doesn't break this week. I just, with all the absolute stupidity of what we're doing on an economic basis by our elected officials, it's mind-boggling. We also have the Michigan Consumer Sentiment Report on Friday, but it's all about Friday. This whole week, unless something breaks in the meantime, which my expectation is something will probably break before the next FOMC, the Fed meeting, and that they may not hike rates. That's just my personal opinion. I hear people on TV talking about, they're going to do quarter point for the next 3 cycles, and I think if they get this one done this month, the longer we go, the more problems we're going to see in the economy. So that's next week. Let's take a look at the investor sentiment, if we can. There we go. Taking a little bit to paint. Maybe if I shut this down, that might help. All right. Investor sentiment was up. The bearishness was up, the 35.1%. We ticked up a little bit in the bullish, a few less people in the neutral category, but we're kind of in the middle here as far as, how greedy you want to be. If you're contrarian, it's a contrarian dial. The more bearish people are, the more greedy this dial will become. But pretty much not a lot of movement, just like the rest of the market this week. Take a look at the fear and greed index, down to, well, it's about 65. It's still in the greed category, which is interesting because the market did nothing to promote any degree of confidence in what's going on. And then let's start to take a look at some of the markets that we have. Dow Jones this week, I think, was down maybe 80, 85, 90 points for the week, which is nothing. It didn't move at all for 5 days, these 5 days here. Let's just kind of look at the weekly and see what that candle looks like. Yeah, I mean, we closed here last week, we closed here this week. So, I mean, nothing. 5 days of absolute nothing, and not even that much high and low with regards to the whole week. Going back to the daily, we'll look at the SPY. It moved 35 cents or something like that, down for the week. I mean, that's like nothing. Again, taking a look at the weekly measure, we can see nothing. Just absolutely nothing. A doji. Then the Qs. This box is actually representative. I do this each week on some of some of my stocks and indexes, like the SPY and the DIA I use for Dow Jones Industrial if I trade it, and then the Qs, which is more NASDAQ oriented. But I'll put this box in here, and this is basically represent 68%. So if you have a normal distribution of, let's see if I can just draw on this thing. So you have a distribution like this, one standard deviation or one sigma, if you will, is 68% here. So that's 68%. Will fall within this line, which it did this week. There was no real outlier. There was very few stocks that actually even moved outside of their one sigma distribution for the week. I look for them. Sometimes there are things that I'll look at to trade if they get outside of those limits, because the tendency is to go back towards the middle at some point, especially if it starts to get two standard deviations out. We're at 94%, and then 99% basically for three standard deviations out there. So those are some indicators, but I do put the 68% because that's what the options displays in the options table. So Qs, I think maybe we're down a couple bucks or something like that for the week. I mean, again, nothing basically, or maybe up for the week. It was up. Oops, got the wrong thing. Nope, it was down for the week. So, we closed last week here, closed this week here. I think it was a couple bucks. So again, nothing really happened in the markets. So it was very quiet, with no economic reports coming out and the Fed not really meeting, and then you have the Fed members saying all the stupid stuff that they say. Then we have the 10-year, which should be representative of, kind of what's going to be happening, with the 30-year mortgages. This was up a little bit. So maybe mortgages will tick up. We'll see what happens on Monday and Tuesday before the Wednesday mortgage rate comes out. And then the DXY, actually, for the week, it wound up popping back up. I had hoped it was in this channel. You see, I drew this channel here, on the way down. I don't know how to use this thing. That's an arrow, by the way. So this is something where it popped up a little bit at the end of last week. This is a daily show, and then it kind of went up, but then it's just kind of sat there. So it's not up really. It's not really down on the dollar, and then on the 10-year, it's the same thing. So the mortgage rate, I would expect to be about the same unless Monday, Tuesday changes that particular outlook. Crude oil actually had popped up a couple weeks ago, and just looking at the week, it actually oil came down for the week. Probably come down and fill this gap here at this point. And then the VIX has just gotten crushed. So this is usually an indicator that, the market should be good, but it moved nowhere. It was absolutely nowhere. So it's continued to move down. That's the weekly. On the daily, you can kind of see in one day where it was slightly up, but it's being engulfed by two red candlesticks there. So it as long as it stays below 20, it should represent good times, but we had nothing, like I said, to report this particular week. So that's really the markets. I don't really have more to say about that. Now, my final comment is I just for informational purposes, I'm an advocate of people not just being a bigger participant in their investments than just handing it over to a person, whether it's a financial planner or somebody who's a fiduciary, which I love that word, for them. But that you need to educate yourself, because if some of the predictions are that we never hit the highs that we've hit or are going to hit, depending on whose predictions you're listening to. But most contrarians at this point would agree that it's not the put your money in and always grow, because we're going to hit highs and then it's not going to grow. So you got to become a more savvy investor. And by virtue of that, there's a lot of stuff out, on YouTube, obviously, where people are touting their wares. And one of the things, I'm both an advocate and a detractor. There are not many people that I trust. And just one of the pieces of criteria, and it kind of bothers me, most of the people who promote a technical analysis, which is just kind of what I do here on the charts, when I look at the market report, is be able to see head and shoulder patterns, double tops, double bottoms. Different candlesticks mean different things, and it's quite the racket. And the thing that I struggle with, even some of the big names that are on TV, promote some of these things. And I'm not saying that they're all grifters, but I would say probably a lot of them are. The thing I struggle with is none of them, I shouldn't say none, many of them, most of them do not show what their performance is. So, they're saying, oh, just do this. And they show you wonderful charts like I just did. And the technical analysis has some statistics, and I'll share some of that potentially next week, where studies have been. But most of the studies it's been a while, except for one. Like I said, and I'll probably share that next week. But there's something called the efficient market hypothesis. It says basically that all of the news is priced into the stock price, and trying to get ahead using technical analysis or whatever is futile. And kind of what I would say to that is, I wouldn't say necessarily that technical analysis is completely useless. I think the important part of any type of trading that you do, and I'm going to differentiate between trading and investing. Investing, for the most part, you buy a stock, you sit it in there like an apple, and it goes up 1,000,000%. And that's what I innovation will always be. There will always be stocks out there that, maybe AI might be one of those things. But the important part to learn about trading different than investing is that you need to learn to manage your risk in each of the trades that you conduct out there. And if once you learn how to do that, then even if you're wrong, you're only wrong a little bit. And the inevitability of you losing money in trading is 100%. You will lose money. Now, you don't want to lose money most of the time. You want to mostly make money and find stocks that wind up going up. So when to cut your risk, do those types of things. And there are certain levels and there's certain indicators. And I'm not going to get into all of that, but I think there's certainly enough education about risk management would have to be number one if you want to look into trading, even whether it's day trading, which I don't suggest, or swing trading, which is maybe a couple weeks to, holding stock for a couple weeks to a couple months, to trend trading, looking for trends that go up. There's a whole series of different things that you can look for. But I think it's important for people to kind of know what's out there. And this also includes fundamental analysis. But efficient market hypothesis basically says TA is all wet. And I agree with that to a certain extent. But I find that technical analysis is useful. And I know it's a contradiction of words there, but a combination of keeping the reality of, are things really priced in to a stock, unless you have insider information, which is illegal, by the way, but hey, it doesn't stop Congress. But the use of technical analysis and fundamental analysis, meaning looking at the financials of companies, similar to what Warren Buffett does. That's what he does. He looks for stocks that are cheap by virtue of what their book value is versus what they're trading at and things of that sort. There are definitely stocks out there right now, I can tell you, that are trading under book. I own the ones that I've found. I'll put it that way. But a combination of, some technical analysis, understanding that a lot of the data out there would say that technical analysis really doesn't work on its own. And then using fundamental analysis along with that should help guide your mindset when you go out to start to learn, that you are skeptical, and that the first thing that you need to learn is risk management, and it can be done. And I may put together an episode on risk management and trading, those types of things. It's a hard thing for, depending on who you are and what your personality is, it's going to be different for everybody. So what I do would be different than what you do, has something to do with risk tolerance. But the other thing, when I add in fundamental analysis, technical analysis, efficient market hypothesis, and then the other thing is basically, what's happening in the economy, what's happening with this inflation, and what stocks, commodities play into this environment. In previous episodes where this happened, doesn't guarantee it's going to happen the same way again, but I typically find that, if gold and silver went up when it was inflationary, back in 1980 when interest rates were going up, and then, in 2000, how it reacted around those times, those types of things are something to educate yourself on. And they help get a bigger picture view on where things are going. And even if you're wrong on a day-to-day basis, if you know where in general the markets are headed, or where you believe they're headed, and sometimes those are two different things, but then you have a better investment philosophy about where you think where things will happen, and then you learn to manage your risk around that. If it doesn't go the way you think, be prepared to adjust your theory. And those are just over the years some of the things that I've learned, not only from doing this, but also from working with large organizations that they hold on to a decision they made 10 years ago that they could never give that up. And it's just ridiculous. You can't do that these days. You got to be willing to be flexible and adaptable to the conditions that are going on around you, and they change. And I suggest people keep up to date with those in these crazy times. I'm telling you, staying on top of some of this stuff, I think, is a personal responsibility. Anyway, that's what I wanted to cover this week. And remember, there is always a better way.